Welcome to our monthly View from the Edge for March 2021. I'm Fritz Folts, Chief Investment Strategist here at 3Edge, and with me today, here once again, Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3Edge Asset Management. And as we do each month, Eric and I will discuss our firm's most recent outlook for the global capital markets, which is based upon our proprietary research model. A quick look back at the global capital markets this week, and I was reminded of the piece that Steve Cucchiaro, our Chief Investment Officer and President here at 3Edge, recently published, which was entitled Market Euphoria, How Long Will It Last? And this week kind of got me thinking that, well, maybe investors aren't so sure how much longer this euphoria could continue. We saw interest rates continue to move higher as investors are more convinced that there could be a strong economic rebound in the second half of 2021, which could lead to higher inflation, which would be a headwind for the equity markets. Investors were also disappointed in Fed Chair Powell's comments this week, which were not quite dovish enough for investors. Then we also got a rebound on Friday with a strong U.S. jobs report, but that was not enough to avoid a down week for equities and a continuing increase in U.S. Treasury yields. So let us turn our attention now to the main asset classes that we model. And as you can see from this chart, as you know, Eric, oftentimes this chart has arrows one way or the other saying that asset classes either became more or less attractive over the course of the month. And here, no arrows, fairly stable. We're still invested in equities, but we're being vigilant and ready to move if need be. So why don't I turn things over to you, and we can start by looking at the equity markets and perhaps Japan, which remains our highest ranked equity asset class. You could start with there.
Yeah, thanks, Fritz. I think it's interesting when you look at a chart like that and you see, it doesn't seem like the model's really changing or nothing's. It turns out under the hood, there are actually a bunch of moving parts. And so things that we're really watching very closely that may actually lend themselves to bigger changes by the end of this month, perhaps. But with regard to Japanese equities, we've been saying that they're the most attractive on a risk-adjusted basis of the equity asset classes that we model. Japanese equities as well as emerging market equities that we'll discuss shortly, I'm sure. There remains these two pillars of support. We've talked about this for some time, but we've seen this tightening high yield spreads. We've observed this for several months and a steepening yield curve measure for Japan as well. And in the case of Japan, that steepening yield curve measure is really largely a function of the longer dated yields rising. And that should be a positive for future economic growth expectations. Japan is also well suited for an investor behavioral breakout phenomenon, and this where new highs are made, and then the buying begets buying. So that's just positive, virtuous cycle. That if that takes root, that would of course be a further positive for that space. And finally, Japanese equities continue to be the only fairly valued equity index that we model. Just yet another positive.
Excellent. So let's take a look at emerging markets actually next. What are we seeing there?
Yeah, like Japan, EM equities also exhibit those two pillars of support, the tightening credit spreads, as well as that steepening yield curve measure. Though in the case of emerging market equities, or the emerging markets more broadly speaking, we're witnessing both the long dated yields rising as well as seeing the shorter dated yields maturities decline. So you're getting a steepening from both ends, and that's a positive for future expected growth in the space. I guess a note of caution here, and this is what we were kind of alluding to in the beginning, the sharp rise that we've seen in the U.S. 10-year yield, that does provide some caution with respect to investments in emerging market equities as investments, as generally speaking, the borrowing costs for EM governments and corporations are very tied to the interest rates in the United States. So that could potentially become a headwind for future projections for this space. In addition, emerging market equities do continue to be very overvalued by our measure. And so that's another headwind for yet why there might not be as large a portfolio allocation in that space as well. So continue to watch that.
All right, very good. And then we'll take a look at U.S. equities where we are basically at our minimum and have been for quite a while. And they had kind of a difficult week this week in spite of a bounce back on Friday. It wasn't enough to push them into positive territory, that's for sure. So what are we seeing in U.S. equities?
Yeah, I mean, not to beat a dead horse here, but we've said for many months now, U.S. equity markets continue to just hover right around their all-time levels of overvaluation, and we performed that analysis back 150 years. So that's not nothing.
Right.
But at the same time, we continue to see, monetary and the potential for this new fiscal stimulus package are just incredibly supportive, helping to fuel these speculative asset bubbles that we're seeing, globally. And that does help keep the outlook on U.S. equities positive. Like Japan and emerging market equities, U.S. equities also benefit from the tightening high yield credit spreads that we're talking about. And then the interesting note about, just while we've talked about these high yield credit spreads, but it is worth noting that the spread has declined. It continues to decline, but the decline we've seen more recently is due to high yield bond yields coming down. But while investment grade bond yields are actually coming up, more in concert with the rise we've seen in U.S. Treasury yields. That's just interesting note. And the question is how much more tightening can actually occur. And so, it doesn't seem like there's a lot more juice left to squeeze. So that's of course another thing we'll be watching quite closely. And U.S. equities are also continuing to benefit, at least for the short term, from this favorable investor behavior. And you alluded to this with Steve's recent paper on market euphoria. And, again, just if folks out there are interested in this topic and haven't yet had a chance to read that paper, it is available on our website.
3edgeam.com. How about European equities, the fourth of the equity asset classes that we look at?
Yeah, this area remains mixed. It has been for a few months now, I think. They remain overvalued, like the emerging markets and U.S. But like other equity asset classes, they also are benefiting from tightening credit spreads. The concern we have here, the big headwind, is in our behavioral filters. We have a section where we're looking for early warning signs of potential. We call them canaries, but these potential warning signs that could lead to sharper drawdowns in a particular equity asset class. And in this case, there were some early warning signs of inflation rising faster than expected in the European economy. So that does cloud the outlook somewhat in the shorter term.
All right, good. All right, so let's switch now from the stock market to the bond market. And again, as we said, interest rates on both the 10-year and the 30, those benchmark treasury yields continue to rise this week. And you've mentioned credit spreads, obviously, when looking at equities. So why don't we cover both of those fixed income wise, rates and credit?
Yeah. In February, we did see the 10-year and the 30-year yields continue to move higher with this, presumably this assumption by investors that there'll be a strong economic rebound in a post-COVID world or in the second half of 2021. And maybe that'll trigger some inflationary pressures. That seems to be the headline. And even at these higher yields that we're seeing now, U.S. Treasuries just still represent just an unattractive risk-return trade-off as they continue to yield less than the market's expected inflation rate, which has been the case for some time. At nearly all maturities, we did see that actually shift with the 30-year nominal yield actually going ahead of the break-even inflation rate. And we'll see if that's a trend that continues for the rest of the curve, or if that was just more of a flash in the pan. Should interest rates continue to move higher, bond market investors, do face that prospect of a loss due to capital depreciation.
Absolutely.
And then with regard to credit, we see investors seeking higher yields, expectations for an economic recovery, and we see the Fed just continuing to be supportive of that credit market, which is, I think, allowing investors to take on, more perceived risk in the high yield space. We've seen the prices of the lowest quality credits, the CCC credits, are actually increasing, as yields decline to near all-time low levels in that space. So that's concerning. And with this record amount of corporate debt outstanding, these record low yields in high yield bonds in particular, there just is heightened risk from our vantage point that any accident in the financial system could cause spreads to widen, sharply, dramatically. And it could just lead to some losses for investors.
What could possibly go wrong?
Yeah,
it's really something, really is. All right, shifting gears again, real assets. We'll look at gold and commodities. Gold continues to struggle in the short term, but commodities continue to push higher. So maybe you could take us through both of those.
Yeah. Gold has struggled recently, but it continues to be supported by negative real interest rates. That's inflation-adjusted rates. Real rates have climbed from being more than 1% negative to about 60 basis points negative, or 0.6 points 0.6% negative.
Can I interrupt you?
Please.
So let's just talk real interest rates really quickly. So you have interest rates, nominal rates, and then you have an expected inflation rate, which is, and so what you need to do is take that nominal rate of interest and take away that expected inflation rate, and that gets you your real interest rate.
Yeah, that's right. If we were to throw out some rough numbers, if the 10-year yield on the Treasury is about 150 basis points or 1.5%, and you subtract out, say, an expected inflation rate of about 2%, you're left with a negative 0.5% or real rate that you're getting, which is really truly a loss of purchasing power.
Right. Yeah, absolutely. Sorry to interrupt.
No, not at all. So that, the point of all this is that you had this negative 1% real rate to a negative 60 basis point rate. So that's an increase of real rates, and that's generally not a good thing for gold to see real rates increase. That being said, they're still negative, so that does err on the side of favoring something like a physical asset like gold or commodities versus, say, a paper asset like bond or currency. But the trend is important, and should rates rise at another 40 basis points, say in another month, on a real basis like that, that would markedly hurt the gold projection.
And then I suppose into this mix, you have the prospect of this $1.9 trillion coronavirus relief package, which they certainly don't have the money to pay for it. So that could have an impact as well, right?
That's exactly right. That was going to be the next point that I was going to mention, is that could certainly raise the prospects for future inflation, depending on the size and how that money is being doled out by the Biden administration, should that fiscal package pass. The other big thing that I think investors were maybe, and you alluded to this early on, was about any recent steps by the Fed to further support the markets, and perhaps you noted that the Fed wasn't as dovish as investors were hoping for. I think there had been some rumblings of yet another Operation Twist.
Right.
They used that first in the 1960s to help. Effectively, it doesn't affect the balance sheet, but it does allow the Federal Reserve to sell its shorter dated maturities to buy longer dated ones to effectively flatten the yield curve, lower borrowing costs. And they didn't necessarily allude to that at all in their most recent statements, and perhaps that's helped fuel a bit of a sell-off that we've seen more recently in gold.
Also reinforces my belief that people on Wall Street, they just want everything all the time, free money, no, 0% interest rates all the time. And if they don't get that, sometimes they throw these tantrums. Anyway.
Yeah, so I think, with all of this that we're saying about gold, which generally seems negative, if there is sustained downward pressure on this price of gold, if we see real rates continue to climb, that's going to be negative, and we will see that manifest in a negative projection for that asset class in our model. We're not quite there yet, but we are certainly keeping an eye on it.
Good. Commodities, did we cover that?
I think we'll do it now.
All right.
Yeah. Commodities do that, as we've said, that hasn't changed. Commodities remain attractive due to their relative undervaluation, particularly with respect to equities. There is this prospect for a strong global economic recovery, and I think we're seeing that. And as the prices of many commodities rise, as investors expect the second half of 2021 to really take off. I think there's also an expectation of dollar weakness, although more recently we've seen the dollar's decline kind of go a bit sideways and be a bit more stable recently. But that would lead to further outperformance for the space, for real assets more broadly.
Another twist that you can see in commodities is that you had such a dramatic slowdown during the pandemic that if you have a dramatic pickup, the supply is not there. There's not enough supply to meet that
That's right.
immediate
Right
demand
away.
anyway.
That's right. That's a great point.
Cash and short-term fixed income.
Yeah. So, at this point, given, we find these opportunities in Japan and emerging market equities, gold and commodities, much of our cash has been deployed into these particular areas. But as we've noted, there are a number of key factors under the hood that are nearing inflection points of concern, where we may need to lighten up on some of these more opportunistic holdings and raise some of that cash to weather some of the potential for future drawdowns in certain asset classes.
Excellent. So that gets us caught up across the major asset classes that we model. So now, my favorite part of the View from the Edge. Eric, you'll give us your 3 most important takeaways from today's video.
Sure. Number one, Japan represents the best risk-adjusted projected return for investors, being that it's fairly valued and has economic and behavioral support as well. All 3 edges, as we would say.
Yeah.
2, gold remains on shakier footing, as we've seen a recent sell-off with the rise in real yields. Time will tell if this is short-lived or the beginning of a more serious and longer-term headwind for the space. And 3, commodities are deeply undervalued versus equities and represent a great opportunity should the global growth expectations come to fruition that investors are hoping for in the second half of this year.
Excellent. Eric, another great job this month. Thank you for getting us caught up in terms of our outlook for the markets. Eric and I will be back once again in early April with the next edition of View from the Edge. Meanwhile, Steve Cucchiaro and I will be back at the end of next week with our latest edition of the 3 Edge Week in Review. As a reminder, all of our videos always available on our 3 Edge YouTube channel, as well as on our website, 3edgeam.com. As Eric mentioned, Steve Cucchiaro's commentary on market euphoria, also available on our website, 3edgeam.com. So on behalf of everyone here at 3 Edge, we urge you to remain safe, to stay strong, keep the faith, and most importantly, thanks for listening.